The great thing is we don't have to do the math anymore, but let's look at the numbers and do the math. Let's assume that you can have no more than 5 positions at a time. You can have as many as you want, but let's assume we're going to limit it to 5. And you're going to buy on the dips 3 times. So you need to calculate the number of shares that you might potentially buy and the maximum price that you can buy them at. So how do we do that? Well, let's assume that you have $50,000 in your account. That means that you can have an average of $10,000 available for each position. Now, some would be more, some would be less, but let's just go with the average. $50,000, not going to have any more than 5 positions, so that gives us $10,000 available for each one of those positions. Now, assuming you're buying even lots of 100 shares, that means you could potentially own 300 shares. If I enter once and I buy once and add twice, that would be 300 shares per position. So how do we find out how much we can pay for a stock? We can't afford to do Apple, can't even do 100 shares for the 10,000. So what kind of stocks can we deal with? Well, you divide the 10,000 by the 300 shares and you find out the maximum stock price you can buy. So when you do all that math and you put it together, 10,000 available per position. You're going to buy 100 shares at a time. That's called even lots, easier to trade, buy, and sell. So you're going to own up to 300 shares per position. We do the math and you break it down, divide the 10,000 by 300, it comes out to $33.33 per share on average. So each lot, 100 shares, is $3,300. So if we do own all 300 shares, and if we did pay $33 a share, that'd be $9,900, and we allocated 10,000. So now we figured out how to get our portfolio from a number, 50,000, to breaking it down into a system. The most I'm going to have is 5 positions. I want to be able to add to it at least twice. So that means I could own up to 300 shares. 5 positions, 50,000, 10,000 in each one, 300 shares, that means $33.33 is the maximum. Now I could do 35, but another one might be 30, but you get the point. We're coming up with a formula that works. And the great news is Cool Trade does it for you. So you add to your position on the pullbacks. So what kind of a drop should I plan for? 5%, 10%, 20%? Well, that's really going to depend on your philosophy and what you see. But I've already told you that pullbacks, 5%, very normal, happens all the time. Corrections, they happen a lot. Well, we haven't had one for 700 days. We're due for a 10%. But if it dropped 20%, bear market, what could cause that? Well, some problems in the world, maybe some embassies shutting down and things happening, world events, maybe an election here or there, maybe a city or maybe a state declaring bankruptcy. Could that happen? It's in the news every day, guys. Absolutely it could happen. Dropping 20% absolutely could happen. So if that's the case, how do we prepare? Well, if you're going to allow for a 20% drop and you're going to buy on 10% drops, that would mean that you need the capital to be able to fund adding stock at least 2 times. Now, when we do the math and we put it all through, you decide if the drop is from your original entry point or from your last addition. You can set it as a specific dollar amount or a percentage. Cool Trade is very, very flexible. So you decide exactly what it is, but to keep it simple, we're going to use a 10% drop from the original price when we open that position. That 10% drop, if you're buying it, let's say rounding it off, $30 a share, and it drops 10% of 30 would be $3. So that means if it drops to $27 per share, we're going to add 1 lot or 100 shares. We're going to add to our position. If it drops another 10%, again, starting from the original number of $3, it's now at 24, we're going to add another lot. So at that point, you're going to own 300 shares. You paid $30 for the first 100, you paid $27 for the next 100, and you paid $24 for the next 100. But you didn't put all your money in at the beginning. You could have bought 300 shares at 30. But instead what we did was we put our toe in the water and then we added at very specific spots. And Cool Trade does that for you. So the Cool Trade philosophy, you're going to add to your positions when the stock drops versus setting a stop loss. Because when we say stop loss, some of you are saying, I'm not even quite sure what that is. Well, watch the other trainings we have here on Cool Trade University, but just to make sure we understand what a stop loss is, it's designed to stop loss. So let me put this chart on the screen and I want you to take a look at it. If you were to buy the stock here at $19 a share and it goes up and down and up and it's now at $20+ a share, you're pretty happy. You're proud. You did well. You bought the stock. It went up. Everything is good. But at some point, the stock may start to go down and it could go down dramatically. If you set what's called a stop loss at 18, that means the most you could possibly lose would be $1 a share. Because you bought it at 19, it went up to 20, but you didn't sell, you didn't lock it in. Now it drops to 18, you're gonna say, that's it, I don't wanna lose any more than $1 a share. That's called a stop loss. So if you just simply exit the trade right there, you've locked in a loss. Now with Cool Trade, with our philosophy, we don't do that. We don't lock in a loss. The Cool Trade philosophy is going to say, you're not going to do a stop loss, you're going to add to that position. Now most people, they don't set up a stop loss either. They assume that they're going to know intuitively, mentally, and emotionally when to get out. The reality is they rarely ever do. They ride that losing position down, and when the pain becomes too much for them, they bail out, many times at the absolute bottom in disgust. Sound familiar? I mean, that was March of 2009 where people were just bailing out saying, that's it, the whole world is going to Hades and I'm out of this market, I'm just going to go to cash. And now they're thinking about just getting back in. So they sold at the bottom, and now they're saying, well, what do I do? Now, if they did set a stop loss, your broker can see that stop loss and they may even trade against you. When I say they may trade against you, again, online trading, you're telling your software with your broker, I'm going to get out here if the stock drops. There's an in-house market maker who sees the other side of that trade. It's possible, not saying it always happens, but they could potentially drive the stock price down to where you've set your stop loss. You've preset it to sell the stock there. They drive it down to that point. You sell the stock to them at the low, and then they bring the stock price right back up. Now, guys, if you don't think that doesn't happen, take your head out of the sand. That is how money works in the market. You can't beat it. You just need to understand it, and you need to work with this. Now, there are other philosophies out there. IBD, Investors Business Daily with William O'Neill. His trading philosophy is very, very clear. There's another trading philosophy, and his is basically if the stock drops 8% from where you purchased the stock, get out. The problem with that is that could happen in a single day. That's called a gap down. Let me just show you a quick chart here. This just happened on a stock that you're all familiar with, Oracle. As you take a look at the top, it says 8.7%. It opened up that day, this is June of 2013, June 21st if I'm not mistaken, it dropped over 8% at the open. It even dropped farther than that a little bit later in the day. So according to William O'Neill, you should bail, you should get out. According to Cool Trade, at that point if the stock dropped 8.7%, this probably is a good time to not sell, but what? Buy more. You're going to add to your position. And if you did, you would have done very, very well. Now, it could happen in a single day, gapping down. The problem is it's primarily a defensive act, and it's going to create small losses in hopes of avoiding bigger ones. That's my problem with that trading philosophy. Now keep in mind, William O'Neill is 80 years old this year, so he's 80 years old. 50 years ago, that philosophy worked very well. 30 years ago, that philosophy of the stop loss and never less than, but today in 2013, where stocks can gap down and the company is fine, it's just bad news or bad earnings or somebody didn't like the color of the product they came out with, the reality is the market moves way too fast and way too volatile to have that as the way that we're going to trade. And it's really defensive and not very offensive. You can't win the game if you don't score any points. So if we're just taking small losses, we're not going to increase our portfolio. There's little emphasis on taking profits, and it's primarily focused on avoiding losses. So the Cool Trade philosophy, again, if you prescribe to either method that I just described, a stop loss or an 8% drop, the next question is, well, when do you get back in? I mean, once you're out and you're in cash, when do you get back in? And the next question is, well, when do you take a profit? You've told me when to get out to avoid a big loss. We're just going to guarantee ourselves small losses, but how do we make a profit? And where do I get back into the market? And when you start to put that all together, some people will even say, and I've heard this told even on TV shows, won't name any names, but people who are on TV shows that like to yell a lot and have sound effects and so on, saying, you should wait to buy a stock until it's breaking out. It's now at an all-time high, and there is no limit. The sky is the limit. So the highest it's ever traded was 700. When it gets to 701, that's when you should buy. Now think that through. If you start to mix these things together, well, I'm going to buy at the high when it's breaking out, and I'm going to sell at the low because I'm going to do a stop loss. We start to pull these things together from these varying philosophies, and you mix them together, and very well in the end, you're confused, you're frustrated, even selling at the lows out of emotion and buying back at the high, waiting for the breakout. Not good either way. So the Cool Trade philosophy is we want you to be prepared. We want you to have that money on the sideline, but we want you to get in the game by opening your position. We're not going to wait for a breakout. The day you turn on Cool Trade, I want you to enter your position. And I want you to have enough capital on the sideline ready to go to purchase additional shares when the stock drops. So you're going to go through the calculations. If I've got 50 and I don't want to own any more than 5, that gives me an average of 10,000 per, and we do our math. Here's the most I can pay for that stock. And if I do a maximum of enter, and I've got 300 shares, we know exactly where we're going to get in, and we're going to add to our position in even lots. We're going to lock in the profits when you have them. That's what Cool Trade does for you. So when we put this all together, when the market corrects, again, I want you to see it's not an if, but it's a when the market corrects. We are due for that. So I want you to be prepared emotionally. It's going to happen. In addition, you're going to see red on the screen with Cool Trade. And when you see that red, you know that the market's coming down. So I want to remind you to remember that relationship between today's profit and loss, the net profit and loss, and the report with the closed trades. We have to add all of those things together. So when you see the red on the screen, don't freak out. Market corrections are normal. I want you to be prepared so we can take advantage of it. This whole special report was really to give you a glimpse of the other side, not just making money, but the money management side, and how to make sure that you know what you're going to be seeing on your Cool Trade screen makes sense. Red isn't bad, red's that opportunity. So be prepared for it. I hope this was helpful to you, learning what to expect when the market does correct. This is Cool Trade University. My name is Gene Guarino, and I want to encourage you, if you haven't even started your real live trading account, do the practice trading, do the simulated trading, and when you're ready, when you gain the confidence, get in. Put your toe in the water. Call support. Let them help you with that. And if you haven't yet, tell somebody about Cool Trade so that they can get involved too. I appreciate you being here for Cool Trade University. Thank you very much.